Thanks so much for joining. Welcome to the first edition of Jrny's webinar series for first-time buyers. I'm Vincent, the co-founder of Jrny, and I'll be your host today. This is part of our effort as Jrny to bring free education around home ownership related topics to all of our customers. Each segment of this three-part series will be dedicated to a specific topic and will always bring along great guest speakers to present their subject matter. Today's topic is understanding mortgages with Eric Miller from Affinity Mortgages. Next month, we'll be covering credit scoring. And finally, in November, we'll be covering alternatives to traditional mortgages. Make sure you stay to the end of each session as there'll be great perks available exclusively to you. And as always, we'd love your feedback and suggestions as to how we can improve this and make it most relevant to you. Before we get going, some small housekeeping. You guys are all by default on mute and your videos will remain off as attendees. At any time during the session, feel free to click on the Q&A tab at the top of your screen to ask questions simply by typing it in. We'll answer all questions at once at the end of the session, including any questions that were submitted in advance to us. And now, with all of that out of the way, let's move on to the agenda so that we can explore what we'll be covering today. Hopefully you guys can all see my screen. So today we'll be covering several things. First of all, we'll get into a brief introduction on myself and Eric. Then we will talk about the mortgage essentials, how to get a mortgage, what the typical mortgage journey looks like, and finally, what you need to do to get mortgage ready before finally answering all of your questions in the Q&A. All right, let's move on to the introductions. Before I hand it over to Eric, just some short words on myself. My name is Vincent. I'm one of the co-founders of Jrny. I founded this business together with my other co-founder after experiencing firsthand how difficult it is to get on the property ladder, even if you're earning a stable income. And that's because, unfortunately, getting mortgages is a difficult thing to do in this country. That's what we're trying to help with. We're both trying to help with getting traditional mortgages as well as offering alternatives to traditional mortgages. Without further ado, welcome, Eric. Please introduce yourself.
Hi, Vincent. Hi, everyone else. Hi, so my name's Eric Miller. I'm a mortgage broker with a company called Affinity Mortgages. We have clients from far and wide who are looking to get on the property ladder. And one thing I would say is it's always worth a conversation. There's a lot of people we meet that don't realise they're actually going to be able to get somewhere. So worth having a chat and seeing what position we're in, because that's what I'm used to dealing with. I'm really passionate about helping people, no matter how difficult their situation. So that's what we're here to do. So just like to talk you through, obviously, the essentials of getting a mortgage. And unless you're one of those lucky few people that have managed to get all the money they need tucked away to buy properties outright, the likelihood is you're going to need to borrow hundreds of thousands of pounds to get yourself onto the property ladder. We want to look at the key to that borrowing potential. And so we've created this short presentation to walk you through what you need to know. A mortgage is typically a loan secured against the property that you're looking to buy. Because that loan is secured against the house, if you do fail to keep up the repayments, there is a chance that you could lose that property. Typically, we need to start with a deposit of just 5%. You can obviously put down a larger deposit and get a smaller mortgage. Some people think back to a time when you traditionally did 10%, but actually there's plenty of mortgage solutions out there with just 5%. That means if you are looking at buying a property for, say, £100,000, obviously you would need £5,000 saved as a deposit. Then there are other additional costs just to think about in terms of fees and solicitors, things like that. Yeah, when we talk about loan to value, we typically say the larger the loan to value, like 95% mortgages, that's where they can be a little bit more restrictive. But that is all about lenders' criteria. So obviously you need to save up a deposit. As we mentioned, a 5% deposit on a £100,000 house, that £5,000 is where you need to get started. So the actual size of the deposit you need will depend on what schemes there are available. As we said, 5% is where it generally starts. And whether you are looking at a standard purchase or one of the alternative options, generally most people have anywhere between 5, maybe 25% for a standard property purchase. The bigger the mortgage deposit, is essentially that's the equity in your home at the start. So that's less that you'll have to pay off over the period of the mortgage, which usually leads to a lower mortgage rate and also leads to a lower monthly repayments. So with your mortgage, most mortgages we tend to start to look at terms of like 25 years. In order to, it really will go up to where we look at your retirement age, where you know that you're going to cease to earn the same sort of figures that you were earning before. That can be typical terms. You said it's 25 years. Some lenders will go up to 40 years. Obviously, again, it's just a criteria thing, but what we want to do is look at getting that mortgage repaid within a period where you are still working and have the income coming in. There's a couple of options. Typical, most mortgages are capital repayment mortgages, where over time you are paying off the balance, the debt that you owe. It is also possible to get interest-only mortgages, where you only actually clear the interest on that. That's not the standard way, but it is there as an option for in some cases. So as mentioned, your first mortgage with capital and repayment, you will see one payment on when you're making your mortgage, but that will be split between capital payments and covering your interest. Okay, there are pros and cons to each situation. The idea really is to clear that debt by the end of term. If for any reason you are on a interest-only mortgage, what you need to do is have a plan in place to be able to clear that mortgage at the end of the term. That can vary from sale of the property and downsizing, or to having alternative savings or investments that will be able to clear the large debt. You also do have the option just with that to do some, sometimes you can get part and part, so it's part repayment, part interest only. That's all something to discuss with your broker and whether it is actually available to you, as lenders can be very strict on these criteria. Now, in terms of the type of interest you can have, typically you can have a fixed rate mortgage, which is for a period of time, you will be able to guarantee what those payments are. Or you could have a variable rate mortgage. Now, while we say variable rate, there are many different options in terms of what can make that rate vary. But again, this is something that we need to discuss to make sure we can suit your your financial position and all your future plans. Pros and cons, obviously, with a fixed rate, you're guaranteed, you know exactly what your payment's going to be. Lenders offer 2, 3, 5, 7 years, 10 years, even 40 years full term, you can get fixed payments on your mortgage. In terms of the variable rates, they can be linked to anything through Base of England Bank of England base rate, my apologies, or the lender standard variable rate, which is something that they have a little bit more control over. Again, there are a number of other options, each come with their own pros and cons. We like to discuss that with you individually because we really have to know what suits you in your position. And surprisingly, getting a mortgage is actually relatively easy part. First step is to talk to someone like me or another mortgage advisor. We can go through your affordability, make sure you have an understanding of how much it's going to cost you a month. Then we can look at getting you agreement in principle. This is a basic credit check run alongside an affordability check, which is obviously taken based on your budget and your income. Once we've reached this stage, then you can go out looking for that dream home. Obviously, you then need to get your mortgage, your offer accepted by an estate agent, and then you can come back to your broker and we can look at applying for that mortgage for you. Once we get that mortgage application in, we'll hand that over. We'll find you the correct lender. We'll double check to make sure we've got the best rate for you. We'll have assessed all of your bank statements, pay slips, ID. More that will go into a underwriter with the lender, and they will sit and they will take care of all of the assessment of your personal documents. Then separately, they will value the property and make sure they're happy to lend on the property as a security. If we don't, once they're happy with all the information we've got, then they will produce a mortgage offer, and then it's just down for the solicitors to do their last bit of work. It is important to note that we do ask for quite a few documents. It might seem a bit heavy-handed at the start, but every lender has their own requirements. Depending on whether you're employed or self-employed, we generally need to verify your identification. We will look at your pay, whether that being pay slips or whether we need to look at your tax returns and tax calculations if you're either self-employed or a limited company director. We will also ask for bank statements, personal bank statements, business bank statements. It's all down to making sure we do the correct amount of due diligence so that once this gets into a mortgage application stage, everything should just sail right through. So I know the mortgage process can be a little bit daunting at times. Just to give you an idea of how long things can take, the average purchase, we'll say, can take between, well, we could say it could take up to 3 months, but 12 to 16 weeks when the lenders really get busy. That's from obviously from day one. Once you've had your offer accepted, you've got to think about getting everybody the right team in place. So we need to think about your solicitor, we need to think about your mortgage lender. You might wish to get your own valuation done on the property. We've got the estate agent that will be there dealing with the vendor. So yeah, just so you can see the chart we've got here. Vincent's kindly put together for us about picking your team, getting your finances in order. One thing I would say, when the people do talk about hiring
I think we're having a small technical issue. Eric, if you hear us, we don't hear you anymore. I think your internet connection might be having some issues.
Yeah. Can you hear me now?
Yes, I think you just have to repeat sort of the last 20
Okay.
seconds.
Oh, the last 20 seconds. Right, back to trying to think what I was saying now. In terms of your solicitor, so it says on the form about hiring a conveyancer, worth speaking to your mortgage broker first. Some lenders will only work with certain solicitors. So make sure we know who your mortgage is going to be with before you instruct a solicitor. Once you have your mortgage offer and contracts are exchanged, we will also make sure we have looked at your any personal insurance you need. We do like to make sure you're taken care of and make sure those payments are covered in terms of life insurance, critical illness, and income protection. But then, yeah, you're good to go. Once the contracts are exchanged, it's just normally a few more dates and then you'll be ready to move in. So we could go on for quite some time about the different stages and everything else we need in terms of getting ready for your mortgage. But just to summarize, it's never too early to start. Have a conversation, get an idea of how much of a deposit you're going to need for the kind of property that you're looking to buy. There are lifetime ISAs and other schemes that are available to help you save up. We will always have a little conversation in the check of your credit history and your credit score. But as we've mentioned before, different lenders have different appetites, so it's important to know what your credit profile looks like. Then we have to make sure we think about our budget. So one thing a lot of people don't factor in is how much is your gas, electricity, and water going to cost? What sort of additional things are you subscribing to in terms of Sky and and other internet providers. So it's worth making sure we have that conversation about what your outgoings are going to be every month, so we know exactly what you'll be able to borrow and whether you're going to be able to fund everything that you need in addition to that. And yeah, as I may have mentioned a few times, it's worth speaking to a mortgage broker. There are plenty of us that don't charge a fee. And if you go to, the advantage we have is that we have the whole of the intermediary market that we can choose from. Quite often people would just go to their standard bank, they'll walk in, they think, great, I've got a mortgage. Now, if you walk in and you manage to get the mortgage you want, that is half of the challenge. What you might not realize is that your local bank might be charging a lot more than some of the other lenders. So we have the ability to continue to search the market, not just for someone that will lend you enough money, but also lend you at the cheapest rate. So if you'd like to if you'd like to get in touch, we can scan this QR code that will take you straight to my page on the Affinity website. Feel free to drop me a message at any point in time.
Thank you so much, Eric, for that presentation on mortgages. Just as a reminder, if you have any questions to Eric on mortgages in general or to myself on Jrny, please put it in the Q&A chat. We did receive a couple of questions from the audience in advance. But before we go there, last chance to scan this link. I'll leave it up on the screen for another 10 seconds. So please do take advantage of Eric's offer of a free consultation to see if you could potentially be eligible for a mortgage already. All right, moving on to Q&A. So as a reminder, at the top of your screen, you should have two buttons, either the chat or the Q&A button. You can put any questions you might have in either of those chats, and we'll pick it up right away. In the meantime, while we're waiting for questions to come in through there, Eric, we did receive a couple of questions from the audience in advance. So the first question, which I'll direct to you, is how long does it take to get a mortgage? I know you touched upon the time scale earlier, but do you have any sort of guidance to our audience as to what the end-to-end process looks like in terms of total time that it might take?
So yeah, I did mention actually it might take 12 to 16 weeks for the house purchase, but actually your mortgage application can be much quicker. We will generally sit down when we have an hour. We tend to like to give you an hour conversation just to go through what's called our fact find. We'll then obviously ask you to gather all the documents in. When it comes to applying for your mortgage, if we've got everything we need, we have had mortgage offers come back in under 48 hours before. The more information we have, and I guess it also depends on the lenders and what information they need, they can do automatic assessments of the property valuation if it's a low enough loan to value. But typically it might take a week of before they manage to process your application on the average. They might come back for some additional requirements, and then maybe another week or so in terms of assessing your documents. Your valuation may take a week or two by the time it gets done. So we do like to have a mortgage offer usually within 3 to 4 weeks. The rest of the process is actually down to the solicitors in terms of searches and other things that they need to do.
All right, well, that doesn't sound too bad then. And Francesca's asking, how much can someone borrow from a bank? Are there typical metrics that our customers should be aware of, or anything that you would look at as an advisor to them?
So I guess if you want just a very, very rough figure, we like to think about maybe 4.5 times your annual salary. And then lenders will deduct any major financial commitments. So I know that doesn't get, it can be a bit vague. Some lenders will decide that your student loan repayments are need to be factored in. Some lenders will decide that they'll treat, if you owe £1,000 on the credit card, some lenders will treat that differently. But that's kind of a real rough idea of where to start. We do have lenders that will lend up to 5.5 times or up to 6 times your income in the right circumstances. But that's all about getting to know you as an individual, so we can then place that with the right kind of lender. The loan to value, as we mentioned before, is something that's going to impact that, as well as not just the amount that you earn, but how you earn that money.
Right. No, that makes perfect sense. And Jeremy asks, let me take this question first before passing it on to you. Do you think interest rates are going to come down? So let me give my perspective. It's always difficult to say. Ultimately, interest rates are decided by the Bank of England, and they look at the general economic environment before deciding whether to increase or decrease the interest rates. They've had to, over the last 18 months, increase the interest rates many times, unfortunately, as a result of the cost of living crisis and in order to tackle the high inflation rates. Most financial analysts are currently predicting that we're reaching the peak of this current interest rate cycle, which means that the Bank of England will start moderating their rate of increase and perhaps even decreasing interest rates going into 2024. Having said that, I think most people currently still expect interest rates to be very high all the way through 2024, which means that unfortunately buying a home can be quite expensive if you need a mortgage, which is ultimately why we're here as Jrny. I don't know if Eric, you have anything to add to that?
So there's a little bit of better news actually. While obviously we know that the interest Bank of England use the interest rates to control the economy, a lot of banks actually lend based on something called the swap rates, which is kind of where the rate at which banks lend money to each other. So what we'll notice is the first time rates really went up, all the banks kind of panicked and they put their rates up too. After that, I think between maybe November and January last year, we may have had 3 or 4 interest rate rises. And actually, the banks didn't increase their rates during this time because they had already secured their funding. So they will borrow a large tranche of money. And once they've decided once they've got that at a rate, they'll be able to continue to lend it to you. Some of the more what we call high street banks are actually they've been reducing their rates over the last 2 weeks. One of them has reduced their rates 4 times, I believe, in the last month. Another one 3 times in the last month. So actually, mortgage rates are coming down despite the Bank of England base rate going up.
Well, that is some good news. A bit of a silver lining. Um, so Miriam asks, can I still get a mortgage if I have adverse credit? I'll give this question to you, Eric.
Yeah, so there are again, while we take a look at your credit profile, adverse credit can involve many things. It can be just some people might have had one missed payment on the credit card. Other people might have had even a bankruptcy in the background. There's a different lender for each type of issue that you've experienced. What we would say is once we've taken a look at the credit profile, then we'll be able to make an assessment. Normally, if you've had a troubled financial past, they may just require a larger deposit and that might be sufficient to get you through. Sometimes it is a waiting period. So some lenders will look at how long it's been since that event occurred and how you've managed your credit since then.
Understood. And Marina asked another question, which was, when is the right time to buy a home? Perhaps let me start by trying to give an answer to that question, and then Eric, feel free to jump in. So, Marina, at the end of the day, the right time to buy a home is whenever you feel financially ready and are ready to make that life move. There's really no other way to for me to answer this question other than that. And the right way to find out whether you're financially ready is to speak to a financial advisor and a mortgage broker such as Eric. They'll be able to tell you whether your current financial situation is good enough to access traditional mortgages or whether you should be looking at other options such as Jrny or scheme or other government schemes that might exist to support first-time buyers. But ultimately, it's up to you and your personal life circumstances as well as your financial life circumstances that ultimately determine the right timing. Would you agree with that, Eric?
Yeah, that's absolutely right. I mean, when people talk about investing, they always say the best time to invest was yesterday. The next best time to invest is today. But it is about making sure you are financially and even mentally ready. We can sit and have a conversation and make sure that you're happy with your affordability, you believe your income is stable, and then it can come down to the type of property you're looking for. Sometimes people want to go, right, I want my forever home and I want it now. that may be possible, and great if it is. If not, you have to decide, do you want to just buy something smaller, grow into that, and maybe even make a profit if that property goes up in value, or would you rather wait and save up the extra money that you might need? I have spoken to plenty of people that didn't believe they were in a position to buy, and felt that they would be living at home or sharing with friends forever. And it's amazing how even just a 25-minute, half an hour conversation can change people's outlook.
Thanks, Eric. And we've received a question in the chat. This one's directed at me. Is Jrny approved by the government? That is a great question. So Jrny is adhering to sort of all the laws and regulations that we're required to adhere to. We're subject to tenancy laws that are applicable to all landlords in the UK. We are not, however, regulated by the Financial Conduct Authority, and that's simply because our product does not fall into the scope of the FCA's regulation, which typically regulates activities around banking and lending. So while we are subject to all regulations that landlords are required to uphold, we are not subject to financial services regulations similar to those of a bank. I hope that sort of provides some clarity on that one. Another question while we're waiting for some in the chat from Thomas in advance, which is quite an interesting one, is do you think Help to Buy is coming back? Perhaps let me offer my perspectives on that. Unfortunately, we don't have any more information than is available to the general public on this question. Help to Buy, just for everyone's information, was a scheme that was introduced by the government several years ago that helped first-time buyers get on the property ladder with a lower deposit. They retired the scheme. They ended the scheme last year in October, I believe. And since then, there have been rumors of a comeback, but nothing's been confirmed by the government. We at Jrny don't believe that it's coming back anytime soon, unfortunately. And part of the reason was because the success of the program itself was somewhat questionable, and from what we understand, there aren't the right incentives in place for the government to bring it back at this point in time. And Eric, just another question for you that we received is it harder to get a mortgage in the current climate?
No, it's not more difficult. There's been a few additional restrictions on affordability. So there may be some lenders that may be a little bit less generous than they were. The process is still exactly the same. It's still about employed people looking at a salary, but there are still so many different options. Even lenders that will take your income 3 months in advance. So you can sometimes have just a signed contract for either a pay rise or for a new employment, and lenders can factor that into their affordability.
Makes perfect sense. And another question we have in the chat is, with Jrny, does it take as long as the mortgage route? So let me take that question. The great news is it doesn't. Part of the reason it doesn't take as long as the typical mortgage route is because with Jrny, we allow you to act as a cash buyer, which means that we don't have to go through the mortgage approvals process, which can sometimes take a lot of time. And the way we go through the conveyancing process is also a bit simpler than when you need a mortgage. So that means that our typical process can be done from beginning to end, from the moment you make your application all the way through the date that you move in as short as 6 to 8 weeks, but sometimes might take a bit longer than that. So one of the key benefits to our customers is that by using Jrny, you can fast track your path towards homeownership versus getting a traditional mortgage. So hopefully that answers that question. While we're waiting for any final questions in the chat, let us take one more question that was asked in advance. This question is, how have recent changes in the housing market affected property prices in the UK? Eric, do you want to take this one?
Yeah, thanks. I'll take the difficult one then. So I guess from my point of view, the things that I see, I don't tend to monitor the prices quite that much. I know there's been a lot of people talking about property prices dropping. A lot of us in the industry believe this is a bit more of a correction after property prices literally shot up when you had the stamp duty holiday. We have noticed a few valuations that come back not as expected, but it's difficult to say whether that's a result of properties really being downvalued or whether it's just estate agents overinflating prices and people maybe having unrealistic expectations of those property prices. In general, a lot of them have held, or maybe there's been a small drop. But because there is a vast difference between new builds and sort of older properties, it's hard to really scale that.
Yeah. No, I think that's a great answer, Eric. Let me just add a bit to that from our perspective. As you can imagine, at Jrny, we're monitoring home prices all the time. Ultimately, we and our funding partners are very much interested in where house prices are moving, and they also benefit, like you, from house prices increasing. What we've seen in the past year, and according to Zoopla and Rightmove data, there's been roughly a 5 to 10% drop in home prices throughout England. Um, Different regions are affected differently. There's some regions that have been more affected, some that have been less affected. Recently, house prices have continued to drop, so they haven't quite reached their bottom yet, but we're hopeful that we'll reach that point in time towards the end of the year, which is when we're hoping to also launch at the same time. And the idea behind that really is that we, at the end of the day, want to launch at a time where both you as our customers, as well as us and our funding partners, all benefit from the increase in property prices, because when you guys win, ultimately we win as well. That's how our proposition was designed. That's how our proposition was designed to work. Great. Are there any other questions in the chat before we close the Q&A? I'll give it a few more seconds for anyone else to ask a final question. I see someone's typing. All right, let's see if that last question still comes through. All right, so I think we just received a question in the chat. How are people's equity protected with Jrny? Are they getting their money back if anything happens to Jrny? That's a fantastic question. And that's really sort of top of mind for us, protecting our customers' equity. So basically, the way it works is that the equity that you pay towards that you build up with Jrny is held in a separate bank account that's completely separate from our day-to-day transactions and is fully secured by the bank. What that means is that if Jrny goes under, first of all of the equity contributions that you made are still protected, and second of all, your option contract against the home is actually still protected because it was registered with the land registry. What that means is not only is your money protected, but also your right to buy the home as part of the contract that you signed with Jrny remains intact. So we've designed it in a way to ensure that you can rest assured that even if Jrny, for whatever reason, whatever unlikely reason, fails, that your equity remains protected. So thanks a lot for that question. Are there any last questions? Last opportunity? All right, the very last question. My landlord wants to renovate his property. I have to move. Do you advise to rent again or go with Jrny, considering the length of time that it takes? That's a great question. I would suggest that you get in touch with our customer success team. We'll send you, I'll ask someone from the team to send you an email afterwards so that we can arrange for a one-to-one call. Ultimately, it depends a lot on your circumstance and the timing of the renovation. So before we get more information on that, I would sort of suggest that you schedule a call with them so that we understand a bit more about your situation, if that works for you. All right. Thanks so much, everyone, for joining the first Jrny's First Time Buyer series. As a reminder, we're coming back next month with a great topic on credit. And finally, we'll conclude the series in November with another webinar. Each time we'll be bringing great guests to present their subject matter expertise, and they'll be available to answer any questions that you might have. Thanks so much for joining, and do let us know by email if you have any other questions that we haven't managed to answer on this call. Thanks so much, Eric, for joining as well. The presentation was great, and we look forward to having you on again.
Yeah, thank you very much for the invitation.